The trade-off between inflation and unemployment, known as the Phillips Curve. As one of Mankey's 10 principles states, society faces a short-run trade-off between inflation and unemployment. This occurs in stagflationary situations in which both unemployment and inflation are the issue. A stagflationary situation is a situation where the inflation rate is high, the economic growth rate slows down, and unemployment remains steadily high. It's represented by a Phillips curve. Developed by A.W.H. Phillips in the 1950s, as he realized that when unemployment was high, inflation rose slowly, and vice versa, when unemployment was low, inflation increased much more rapidly. This inverse relationship is seen on a Phillips curve. In the long run, there is no relationship between inflation and unemployment, so the long-run Phillips curve is simply a straight line. In a stagflationary gap, it is seen that the supply has shifted to the left of equilibrium, which was originally at point A, and created a new equilibrium at point B, in which prices have risen, inflation, and aggregate outcome has fallen, an increase in unemployment. The only aspect of this graph that we can control is the demand, so as we attempt to fix the issue, shifting the demand to the right, we arrive at point C, in which the unemployment is simply back at where it was initially. But now, the price level has risen past where it was at point B. This represents the trade-off. As unemployment is resolved, inflation worsens, and if inflation were attempted to be resolved, unemployment would get even worse. Inflation and unemployment are related to aggregate supply because it takes workers to produce the supply of goods, and wages tend to be one of the largest expenses for businesses. Because of this connection, whatever events lead to a shift in aggregate supply will also lead to a shift in the short-run Phillips curve, whether they are positive or negative. A rightward shift of the Phillips curve occurs when there is a negative supply shock, or a decrease in aggregate supply. As the supply increases, moving to the right, at each point the unemployment rate corresponds to a lower inflation rate. Examples of factors that shift the curve to the right are an increase in expected inflation, an increase in the price of oil from abroad, a negative supply shock, such as damage from a hurricane, or an increase in the minimum wage. A positive supply shock that would cause an increase in aggregate supply would shift the curve to the left. As the supply decreases, moving to the left, for every given unemployment rate, the corresponding inflation rate is now higher. The trade-off becomes more severe as supply decreases and less severe as supply increases. Examples of what will shift the curve to the left are improvements in technology across the economy, a decrease in expected inflation, a decrease in the price of oil from abroad, or a positive supply shock, like when aggregate supply increases when minimum wages decrease. Other reasons for shifts are expected rate of inflation that will cause a shift in the Phillips curve, or as workers expect a rise in prices, they'll bargain for higher wages in order to adapt to the economy. If employers expect that they can raise prices, they will agree and increase the wages. However, in another situation, if unemployment is low, therefore there's low competition for workers, employers can't deny wages as easily to the demanding workers. Inflation occurs more rapidly as workers demand higher wages in low unemployment periods, shown through the correlation to the curve. If expected rates of inflation is higher, curves will shift to the right. An actual rate of inflation increases while unemployment stays low. If expected rate of inflation decreases, shifts to the left, and an actual inflation decrease is seen as unemployment rises. Expectations for inflation lead to an actual change in inflation and unemployment. After the economy has adjusted to these inflationary expectations, relationships between inflation and unemployment is now represented by the long-run Phillips curve, not the short run. As we saw earlier, the LRPC is simply a vertical line and shows that there is no correlation in the long run between inflation and unemployment. Attempting to keep unemployment rates below the NAIRU leads to accelerating inflation rates and cannot be maintained over time. Trying to keep the unemployment rate above the NAIRU will lead to accelerating deflation, which can similarly not be maintained. The long-run Phillips curve is vertical because any unemployment rate above or below the NAIRU cannot be maintained like stated before. No policy can maintain unemployment rates other than NAIRU in the long run. Additionally, there is no long-run trade-off between inflation and unemployment. so a vertical line shows the lack of a relationship. In conclusion, the Phillips curve represents the trade-off that society faces between inflation and unemployment in stagflation situations. The short run is an inverse relationship and convex to the origin. The long run is a vertical line because of the lack of a relationship. Shifts can occur due to supply changes or simply changes in expectations.